Can you profit from stock volatility? By www.options-trading-education.com. Investors are in anguish as stocks fly up and down. The question for options traders is, can you profit from stock volatility? USA Today reports that Wall Street volatility rules as stocks fall again. Volatility continues to rule on Wall Street as stocks bounce around in choppy trading Tuesday amid oil weakness and global stock turmoil that saw Japanese shares fall more than 5% overnight. Global investors are experiencing high anxiety as a dismal start to 2016 continues. There has been a flight from risky assets such as stocks as investor worries mount over a myriad of risks, including slowing global growth, a steep decline in oil prices, uncertainty over interest rate policy in the U.S., and, more recently, concern over the health of banks, mainly in Europe. Options traders commonly follow the VIX as an indicator of volatility. Barron says that the VIX indicates that the market rout is far from over. Despite the carnage, the options market is indicating that stock prices may fall even more sharply before the current malaise ends. The CBOE Volatility Index, VIX, often called the stock market's fear gauge, is just under 30, which is an elevated level, but far from telegraphing extreme fear. You haven't seen the selling climax. VIX is in the 20s, not in the 30s, and nowhere near 40. There is no panic selling. No one is doing anything, a senior trader at a major trading firm says, referring to options, not stocks. For reference, the VIX hit an all-time high of 89 during the financial crisis in October 2008. To be sure, that was an extreme level. The high 40s seemed to be a more pedestrian panic peak. Meanwhile, options traders can profit from stock volatility. Option trading is an efficient way to approach volatile markets. You do not need to buy or sell stocks, but rather buy or sell puts or calls, which is less expensive and offers a way to leverage your trading capital. The long straddle. Oftentimes in a volatile market, a trader knows that the market will move, but the direction is not clear. A classic approach to such a market is to use a strategy known as a long straddle. A long straddle is buying both a call and a put on the same stock with the same expiration date. In a long straddle option strategy, the worst a trader can do is lose the cost of the premiums paid for the call if the stock does not change price. However, this options trading strategy has potentially unlimited potential if the stock price changes significantly. If the stock price goes up, the trader exercises the call option, sells the stock at the spot price, and buys at the strike price. The profit is the price of 100 shares per contract at the spot price minus the strike price minus the cost of premiums on both put and call options. If the stock goes down in price, the trader exercises the put option and sells the stock at the strike price and buys at the new lower market price, the spot price. The profit will be the price of 100 shares per contract at the strike price minus the spot price minus the premium cost of both put and call options. This is a time-honored approach to making a profit in a volatile market. For more insights and useful information about trading options, visit www.options-trading-education.com.